Hello everyone, it's Elliot Gu here with the Free Market Speculator and Smart Bonds, and welcome to my Sunday Deep Dive. In this weekly video, we take a look at a key chart, trend, or indicator that caught my eye over the past week, and I explain what it means, or at least what I think it means for financial markets. Now last Wednesday, the Federal Reserve's Federal Open Market Committee, the FOMC, they announced their first interest rate decision under the central bank's new chair, Kevin Warsh, who officially replaced Jerome Powell on May 22nd of this year. So he's been on the job less than a month. Warsh also hosted his first press conference and Q&A session on Wednesday afternoon. Now the last time the Fed had held an interest rate decision under a new chair, well, that was back in March 21st, 2018, when Jerome Powell took over from Janet Yellen. Before that was March 19th, 2014, when Yellen took over from Ben Bernanke. And before that was March 28th, 2006, when Bernanke took over from Alan Greenspan, who had been Fed chair since 1987. My point is that shifts at the top of the Fed, they aren't common. So what I want to talk about today is how Kevin Warsh performed last week, and what the new chair and the changes he's making mean for interest rates, bonds, and stocks. So let me start with a statement before we dive into the data. I liked what Kevin Warsh had to say this past week, and I believe his term as chair will mark the most important shift at the central bank in 20 years, going back to 2006, when, as I said, Ben Bernanke took over from Alan Greenspan. Of course, the knee-jerk reaction from markets appeared to be negative. Stocks were down and two-year Treasury yields sharply higher on what Wall Street perceived as a hawkish hold. And there are plenty of journalists and economists out there talking about how his proposed more opaque approach to monetary policy, something we'll cover in more depth here in just a few minutes, increases market uncertainty and market volatility. However, when you dig a bit deeper, the picture changes. The stock and bond market reaction wasn't as bearish as it first appears. Indeed, the real read is positive for U.S. economic growth and bullish for bonds in my view. Ultimately, I'd argue that despite what you may have heard or read, markets actually liked last week's performance from Warsh too. That said, it does mean investors will need to start thinking about monetary policy in a little bit of a different way than they have since the Great Recession and financial crisis years of 2007 to 2009. So let's start with this. To create this chart, I examined the performance of the S&P 500 intraday on every scheduled Federal Reserve FOMC announcement day since February 1994. Specifically, I looked at the S&P 500's return on announcement day, which I defined as the stock market opened that day through the close, and again, on Fed decision day. Rather than expressing the returns on an absolute basis, I created a Z-score based on the S&P 500's action on the prior 24 announcement days. So since 1981, the Fed has conducted 8 scheduled meetings per year. So this Z-score is based on roughly the prior 3 years worth of Fed announcement dates. I find looking at the data more valuable in Z-score form rather than on an absolute basis, because let's face it, stock market volatility today is different than it was in the mid and late 1990s, or even 5 or 10 years ago. So this gives us a cleaner read on how good or bad the stock market reaction was based on more recent history. Now, as ever, financial journalists like to use, sensationalist language to describe the market's reaction to news because it attracts attention and eyeballs, right? This knee-jerk reaction score provides a more sober and dispassionate take on what happened and whether it's just noise or actually a signal for you. I've also included horizontal lines marking positive and negative 1 and 2 standard deviation Z-score reactions, so you can get an idea of how extreme Wednesday's market sell-off is compared to past Fed meeting reactions. The S&P 500 sold off 1.39% from its open on Wednesday to the close on the same day. Based on the market action following the last 24 FOMC announcements, that was a negative 1.37 standard deviation event. So that's an outlier, but not really an extreme event. After all, the 1.09 standard deviation, negative 1.09 standard deviation reaction to the March 18th this year Powell announcement was almost as bad. And the negative 1.99, almost negative 2 standard deviation reaction to the December 18th, 2024 meeting, well, that was far worse. Now here's a look at the reaction z-scores for the first 2 meetings under new Fed chairs since Bernanke's first in March 2006. So on this basis, Warsh's negative 1.37 standard deviation z-score, well, it's the worst on my table. That said, Powell's second meeting at negative 1.25 standard deviations in May 2018, well, that's not far behind. And the reaction z-score following Powell's December 19th, 2018 rate announcement, which was less than a year through his first term as Fed chair, that was the worst since 1997 at negative 2.65 standard deviations. Now, of course, this is a small sample size. As I said, there haven't been that many Fed chairs in the last 30 plus years. So this is not statistically significant. But I suspect there's really not a ton of information content here, as I'd argue that there's more uncertainty about Fed policy today than very early on in the Fed tenures of Bernanke, Yellen, and Powell. Of course, that changed as time went on. Bernanke was Fed chair through the financial crisis years. Powell had certainly tests through the COVID era, but early on in their terms, the markets were a little quieter, less uncertain than they are right now. So we'll examine that issue here in more depth in just a minute. The more interesting reactions to Wednesday's Fed announcement, well, it wasn't stocks, but it was bonds. Let's start with the 2-year note. The chart shows the z-score of the move in 2-year Treasury yields on Wednesday. Now, a positive z-score indicates a rise in 2-year yields, which implies a sell-off in Treasury prices, a bond sell-off. And the mean and standard deviation are based on the prior 24 meeting history. That's the same basis as the stock return z-scores I just outlined. I'm using the yield change from Tuesday's close to Wednesday's close rather than measured from the open price in this case, mainly because opening yield data for the 2-year Treasury note, it isn't available for the full historical sample I wanted to analyze. At any rate, the 13.6 basis point rise in 2-year yields on Wednesday, that's plus 0.136%. That's more meaningful and more unusual than the move in the S&P 500. The z-score there is positive 1.61. Now that's similar to the positive 1.68 z-score spike we saw following the Fed's October 29th, 2025, last year interest rate decision. Before that, you'd have to go all the way back to the Fed's hawkish pivot in early 2022 in the form of the plus 2.45 and plus 1.94 standard deviation z-scores back on January 26th and March 16th, 2022, respectively. And here's where this analysis starts to get, I think, even more interesting. Now, this chart shows the 10 and 30-year yield reaction z-scores on the same basis as I used for the 2-year Treasury. And that's a blue line for the 10 and an orange line for the 30-year. Now, as you can see, the 4.8 basis point, that's 0.048% rise in the 10-year Treasury yield on Wednesday represented, it's little more than noise. It was a plus 0.88 standard deviation event. And the 30-year Treasury market truly yawned. The yield on the 30-year fell about 1.5 basis points on the session. That's a negative 0.10 standard deviation event. We haven't seen a reaction in 30-year Treasuries this modest in almost 2 years, since July 2024. One more market reaction caught my attention. Now, I've written and spoken about the ICE Bank of America High Yield Options Adjusted Spread, the OAS spread, in this publication before. This spread measures the interest rate paid by high yield, what we used to call junk borrowers, companies with less than investment grade credit ratings, relative to bonds of equivalent duration. So a rise in this spread indicates increased stress in credit markets, a spike in the spread, and in many cases concerns about the health of the economy. Now that's because a rise in this spread means investors are demanding a higher yield to accept the additional credit risk of lending money to corporate borrowers with shakier credit. Well, on Wednesday, credit spreads actually fell by about 8 basis points, right? On a 24-month rolling or 24 meeting rolling z-score basis, that's the largest downside reaction in spreads, almost negative 1.5 standard deviations in more than 4 years. So what do these reactions in stocks, treasuries, and credits actually mean? What is the market trying to tell us? Well, the sharp pop in the 2-year treasury yield, as I said, a plus 1.61 reaction z-score, 1.61 standard deviations. Well, that's a clear indication the market interpreted the Fed announcement and Warsh's press conference as hawkish. That's because the front of the curve is most sensitive to Fed policy, and it reflects the market's outlook for Fed policy over the next couple of years. Hawkish hold, the Fed left rates unchanged, but hinted it may need to hike rates in the future, is the takeaway that we heard in the financial media. That was what we heard repeated endlessly the past couple of days. At the same time, the other moves I just outlined were not as widely reported, not at all, frankly, and are arguably even more important. Specifically, 10-year yields saw only a modest rise, plus 0.88 standard deviations, while both 30-year yields and credit spreads actually fell. The decline in credit spreads was the largest in years, as I said, a negative 1.5 standard deviation reaction z-score. These reactions suggest 2 main points. First, markets are sanguine about the economy. Even though the market read the Fed announcement as hawkish, credit spreads fell, which is a clear indication that markets don't see short-term rate hikes as a threat to borrowing costs or credit quality for more economy-sensitive junk or high-yield borrowers. Second, markets see Fed policy, including those rising expectations for hikes into early 2027, which we can see, as neither overly restrictive nor overly accommodative, right? Not too tight, not too easy. Recall, as I've explained in prior updates, an inverted yield curve is not a recession signal. It's a signal that the market sees monetary policy as restrictive. Inversions happen when short-term interest rates rise faster than long-term yields. So consider the yield curve measured as 10-year yields less 2-year yields. Here's the data on this version of the yield curve since the mid-70s, courtesy of the Federal Reserve Bank of St. Louis. As you can see, in the mid-1970s, the yield curve was fairly steep actually, reaching a high over 160 basis points, 1.6%, in late 1976. The Fed had started easing policy in response to the nasty recession of 1973 to 1975, driving down 2-year yields. Meanwhile, the 10-year yield also fell into late 1976, but not as quickly as the 2-year. And so that resulted in a steeper curve, right? The message, the market was essentially saying that short-term interest rates, the 2-year, were low relative to what was expected longer term. That's the 10-year Treasury yield, given the outlook for inflation, economic growth, and monetary policy. Clearly, that all changed as Paul Volcker, the Fed chair in the late 70s and early 80s, aggressively hiked short-term rates, leading to the most inverted yield curve on my chart at over negative 240 basis points in early 1980. The market was then screaming, right, tight Fed. An inverted yield curve often leads to recession. That's because in most post-war economic downturns, tight monetary conditions ultimately slow down economic growth and tip the economy into recession. So you get a period of inverted curve followed by a rapid steepening as the Fed cuts rates aggressively, shifting from fighting inflation to supporting growth. Now, now, the 10-year, 2-year yield curve is not inverted, though the slope is shallow at positive 27 basis points, and the curve has flattened in the past few weeks and since late last year. The slope on this basis was about 39 basis points positive on Friday, June 12th, and as high as 73 basis points positive in late 2025, late last year. However, look at the yield curve in the mid and late 1990s under Alan Greenspan. I'll box it in the chart on your screen. Back then, the yield curve was also flat for several years. In fact, in 1998, the 10-year, 2-year curve inverted, albeit only slightly and on the short-term basis, with a maximum inversion of about 7 basis points in the summer of 1998. This shallow yield curve was a sign the market saw Fed monetary policy as neither overly restrictive, a deeply inverted curve, nor accommodative, which would be a steep curve. I believe we're getting the same message today. The rise in the 2-year yield suggests on Wednesday, right? That suggests the market sees the Fed hiking rates and remaining on top of inflation. If the Fed were seen as losing credibility on inflation, then longer-term yields would have spiked as well, which they did not. Similarly, the market doesn't see the Fed over-tightening and risking recession. 10-year and 30-year yields were quiet, and credit spreads actually fell. And, lest we forget, right, returns for the stock market were among the strongest in history back in the mid and late 1990s, when long-term treasury bonds produced high single-digit gains, right? And high yield and investment grade debt also performed very well, better than the long-term average for both markets. So while a flat yield curve and balanced risks around monetary policy implies some level of uncertainty in markets, right? It's not bad news for either the stock or the bond market. It certainly wasn't in the mid and late 1990s. And that brings us to this. This table shows the performance of the S&P 500 on Fed announcement days compared to the performance over the next 5 trading days. Now, I've divided the entire table sample since February 1994 into 3 eras, right? The period before the global financial crisis, GFC, the zero lower bound era of near zero rates and quantitative easing from September 2008 through February of 2022, and then the period starting in March 2022. Now look at the R value and OLS, which stands for ordinary least squares, slopes from the pre-financial crisis era. They're negative numbers and statistically significant at the 95% confidence level. So the p-value is 0.043. That means that before the autumn of 2008, right, the S&P 500 tended to reverse Fed day moves. When the S&P 500 rallied on Fed days, it tended to sell off in the ensuing 5 days, while the market tended to reverse higher following knee-jerk negative reactions to Fed days. Then, during the long zero lower bound for rates, the quantitative easing era, that reversal effect disappeared. While still negative technically, the correlation and OLS slopes were tiny and statistically totally insignificant. The p-value here indicates a 35% chance that the modest negative correlation between stock returns on Fed day and the subsequent 1-week move in that era, it was solely due to random sampling variability. Finally, since 2022, we've seen a return to pre-global financial crisis conditions. Since the spring of that year, the S&P 500 has tended to reverse its Fed day moves over the subsequent 5 trading day periods. And the R value and OLS slopes are both similar, very similar in magnitude to that pre-crisis level. Now, it's important to point out that the result is not yet anyway statistically significant, mainly because the sample size is so small. There have only been 34 meetings since early 2022. Not conclusive, but the stock market is strongly hinting at a Fed stock market reaction function returning to the pre-crisis, pre-GFC, pre-quantitative easing norms. And we saw this effect again last week. The S&P 500's 1.39% intraday sell-off on Wednesday, Fed day, mostly reversed on Thursday with the S&P 500 up 1.08%. So at this point, you might be wondering, who cares? Well, think about what this means. Prior to the crisis years of 2008, the Fed would issue an announcement and the market would rally or sell off, presumably based on how the Fed's decision compared to the market's consensus expectations, prior to that release. Then, in the days following that initial knee-jerk reaction on the afternoon of Fed Day, there was a strong tendency for stocks to mean revert, as the market took a few days to digest the release and recalibrate expectations. Here's what's crucial. This was a period before the Fed started issuing explicit forward guidance on policy. That started in 2008. And it was before the Fed started hosting press conferences and question and answer sessions with reporters. That was in 2011. In other words, for the stock market anyway, there was real information content on Fed Day, and markets took a few days to fully digest and process the news. When the Fed started issuing explicit forward guidance, hosting press conferences, and publishing a quarterly dot plot to show expectations for rate hikes or cuts from all FOMC participants, that effect disappeared. There was no stock market reversal or equity market mean reversion because the Fed was effectively telling the market what it planned to do well ahead of time, often several meetings in advance. Markets began to care more about what the Fed said, and expectations were anchored to that dot plot, rather than incoming economic data, stock market data, or market signals. No surprise, no shock, no uncertainty. Just the Fed leading markets around like a dog on a leash. The Fed became a market manager. You could even say a babysitter for markets. And when the data drifted away from what the Fed's dots implied, or the Fed stopped offering as much granularity in their guidance, indicated any level of uncertainty, markets rebelled. And we saw what came to be known as tantrum episodes in stocks and bonds. There were several in that era. As I said, the data isn't statistically significant yet, but there's a loud whisper that we're returning to that pre-crisis norm for stocks. How about bonds? Well, look at the 2-year Treasury yield reaction function on the same basis. The situation here rhymes. Prior to the financial crisis years, press conferences and forward guidance, there was a strong tendency for 2-year yields to reverse knee-jerk reactions to Fed announcements. The mean reversion was statistically significant at the 97% confidence level. That effect disappeared after the autumn of 2008 due, I suspect, to the same basic reason as for stocks. Specifically, in an era where rates were largely pinned at zero, and the Fed made a point of telling markets pretty much exactly what it intended to do months ahead of time, right? Markets' initial reaction was correct, and there was little real information content in Fed announcement days that needed digesting. The big difference here is that we have not yet seen a return to pre-crisis norms in the 2-year Treasury market since 2022. The result is not statistically significant. The p-value is 0.784. So that's likely because we just haven't seen enough data yet to determine if there has not been a shift. I suspect that we will see a shift there in coming years, just as we're seeing for the S&P 500, for pretty much exactly the same reasons. And that brings me to specifically what Kevin Warsh and the Fed said and did at last week's meeting. First, the FOMC statement released at 2 p.m. Eastern Time was just 130 words long. Now that's less than half the 343 words in the Fed's last statement on April 29th, under former Chair Jerome Powell. One must go back to the late 1990s or the very early 2000s under Alan Greenspan to find examples of similar brevity. In those years, policy statements routinely came in at under 150 words, in line with what we saw last week. The most striking shift in the statement itself is the lack of forward guidance. The Fed's policy, as I said, of attempting to communicate the likely path of rates in coming meetings, and whether the Fed is more concerned about a weakening labor market or upside risk to inflation. That too resembles the Greenspan era prior to about 2000. Investors and traders who entered financial markets after the 2007 to 2009 financial crisis years may find this next point tough to imagine, but prior to February 1994, the Fed didn't even directly communicate changes in the Fed funds rate target to markets as part of a statement. Instead, market participants watched the Federal Reserve Bank of New York and their open market operations to ascertain indirectly, the stance of monetary policy. Then in February 2000, 6 years after that first explicit statement on target rates in February 1994, the Fed started including statements about the balance of risks around the Fed's mandate. More than 3 years after that, in August 2003, the Fed added language about maintaining accommodative policy for a considerable period to the Fed statement, a sort of qualitative forward guidance. It really wasn't until December 2008 meeting under Ben Bernanke that the Fed started to offer more formal, explicit guidance on rates. Along a similar line, Kevin Warsh also stated that he declined to offer projections for the central bank's quarterly summary of economic projections or the accompanying infamous dot plot. The SEP, Summary of Economic Projections, details projections of FOMC members, including their median projections for economic growth, inflation, and interest rates. Meanwhile, the dot plot details forecasts for the appropriate Fed funds rate for, in this case, year-end 2026, 2027, 2028, and the longer run, with each dot representing the view of an individual FOMC participant. Warsh has been critical of the SEP and the dot plot. Right now, for example, he noted that he did not hear a lot of conviction from Fed participants on their forecasts, and the SEP provides a level of precision on the likely path of monetary policy that simply doesn't exist. He strongly hinted that changes to Fed communication, including the SEP, are likely later this year. And that brings me to what might be the most important statement from the entire press conference. When asked whether eliminating forward guidance and de-emphasizing the quarterly SEP and dot plot might increase market volatility and uncertainty, Warsh had this to say, and I am quoting him directly. So, I think financial markets perform best when they react to incoming data. I think financial markets work less efficiently when they ask a question. How will the Federal Reserve react to that incoming information? The more that markets are paying attention to what's happening in the real economy, deciding what's good data and what's less good data, the more financial markets can price what they believe is the most likely and what are the most likely path and what are the tail risks. Financial market prices are probably the most important source of information to guide central bankers. But when all the financial markets are doing is reflecting back what we've said, then we're taking the most important source of information and we're being blind to it. I'd like us to create a system where those blinders come off, where markets are following data that they efficiently think is reliable. And they'll be watching data. We'll be watching data. They'll come with better information through market prices to us. We can make more informed decisions. End quote. The main criticism of Kevin Warsh's performance last week were that by giving markets less guidance, less information, and less detail on the Fed's thinking, he's going to boost uncertainty and market volatility. He's going to create more surprises. That's all true, and the data we looked at from the pre-crisis era proves it. However, volatility and uncertainty aren't always bad things. You see, financial markets are in the business of price discovery, and that's a messy process. It's a process that involves millions of traders, investors, and economic actors of all sizes, all expressing their views on stocks, bonds, and commodities with real money. Some of these participants are very savvy. Others, well, probably not so much. However, collectively, market prices represent the wisdom of millions of people who, again, are backing up their opinions with real money. They're not always right for sure, but generally and collectively, they are more right than any single economist, strategist, academic, or so-called expert. Markets are messy, but they work. And it goes beyond financial markets too. That's why, for example, we've seen political prediction markets come in more accurate than the pollsters in recent election cycles, including 2024. Kevin Warsh spent 7 years at Morgan Stanley and later as a partner at Duquesne Family Office. That's the private investment firm of legendary hedge fund manager Stanley Druckenmiller. He knows markets, and I suspect he knows the value of listening to markets. As he indicated in his presser last week, he believes that markets are the most important source of information for central bankers. His words, not mine. Market trends, whether it's in stocks, bonds, commodities, or credit, should provide their wisdom to the Fed rather than the Fed seeking to control and manage the markets through forward guidance, lengthy speeches and prognostications from FOMC members, and the like. I won't name names, but a good chunk of the criticisms of this shift that I've seen is coming from journalists and economists who are known for analyzing subtle shifts in Fed statements, determining what the Fed wanted to say by omitting language from one meeting to the next, even allegedly passing on or receiving leaked information from the Fed itself to guide markets. Those who benefit from reading the tea leaves, turning the economy into a political debate, or simply a question of what the Fed will do next, rather than the real work of analyzing markets, intermarket relationships, and economic data. Now, I'll admit that there may well have been a time when forward guidance and enhanced Fed communications did make a ton of sense. After all, when you've already cut rates to zero, telling markets you have no intention of raising rates, well, it's a powerful way of easing financial conditions. So too, issuing calm words at press conferences. I think most would agree that's exactly why Ben Bernanke made these changes in the first place. However, as most listeners are aware, rates are no longer at 0%. And yields on the 30-year Treasury, for example, have recently tested pre-crisis levels, pre-2008, 2007, 2008 levels. Inflation is a real issue once again. And the Fed's own guidance has arguably tripped up the central bank and markets a good deal in recent years. In June 2020, then Fed Chair Powell stated, "We're not thinking about raising rates. We're not even thinking about raising rates." This helped anchor market expectations about lower for longer rates so firmly that markets were caught flat-footed by building inflationary pressures in 2021 and the Fed's aggressive pivot from ultra-easy monetary policy to aggressive tightening in 2022, that whiplash year. And that produced one of the most vicious coordinated stock and bond market craters in history. We're no longer in a crisis market, so why persist with crisis-era policies and norms? Why lead financial markets when markets have proven better than central banks in predicting or anticipating the future and guiding policy for decades? The goal of policy isn't, or at least should not be, to suppress volatility or have the Fed and the government control markets. Markets are not regulated utilities. Markets have already recognized these shifts. That's why you're seeing the changes in the Fed reaction function I just outlined. Fed Chair Warsh has just formalized the situation while promising to create 5 different task forces to evaluate key elements of Fed communications and monetary policy. That includes a closer look at data the Fed relies on to conduct policy, including the Bureau of Labor Statistics monthly employment report that's been plagued by huge revisions in recent years. As longtime readers know, the declining quality of that BLS employment data is something I've written about, talked about a great deal, and is something that several Fed members, including former Chair Powell, have discussed in one form or another. Why pretend data quality isn't a problem when it clearly is? So there you have it. The Fed reaction function, the market reaction function to the Fed meeting last week wasn't bad. The stock market reversed much of its one-day loss on Thursday. Long-term bond yields and credit spreads fell, and the yield curve remains flat, just as it did through the mid and late 1990s, a great time for stocks and bonds. Less guidance and hand-holding from the Fed isn't a dangerous new policy. It's the pre-crisis status quo. And it makes sense for markets to focus on price discovery and forecasting rather than dissecting Fed speeches and subtle language changes. Now, I've had a few requests in recent weeks for a deep dive into the oil market and the current situation in the Strait of Hormuz, which is rapidly evolving. It's fluid, if you will. I am planning a written post next week diving into more specifics on that issue, including an update on recommendations for paid tier readers in the Energy Bulletin Top 10 portfolio. I'll also look to feature energy again in an upcoming Sunday deep dive. If you enjoyed this week's video, please drop me a like. or a comment. And you can subscribe for free to make sure you receive this weekly video and my other posts and updates when they're released. If you'd like to give the paid tier of Free Market Speculator, including our highly popular Energy Bulletin Top 10 model portfolio, if you'd like to give that all a try, I'm offering 30-day free trials via the link below this video. And while I keep hearing talk about higher for longer interest rates and a bear market in bonds, I just calculated the performance of the model portfolio in smart bonds, and the baseline allocation there is up 6.73% over the past year, 52 weeks, with more than 60% less volatility than the S&P 500, and a yield over 5% on average. Meanwhile, our dynamic 60/40 portfolio of stock and bond ETFs, well, that's up 19.3% over the same holding period. For a strictly limited time, I am offering 60-day free trials to the Smart Bond service. I'll include the link for that also down below. Our detailed quarterly update and outlook issue of Smart Bonds, it's due out next month in July. So free trial readers will get that issue as well. Thanks again for listening. I'll see you next week for another episode of my Sunday Deep Dive.